Every investment property that you buy is going to have these 5 expenses. You're going to have to pay for your property taxes. You're going to have to pay for your property insurance. You're going to have to pay for your property maintenance. You're going to have to pay for your property management. And then you're going to have to pay for vacancy costs if there are any. Now, this isn't money that's coming out of your property per se, but this is money that you're not making. So when you're factoring the numbers, when you're doing the deals, you have to make sure that you look at all of these costs to make sure that the property is still going to be profitable for you. So when it comes to taxes, I'll kind of work down this list. When it comes to taxes, what you have to remember here is that the seller's taxes that they're paying today is not necessarily going to be the taxes that you pay after you purchase the property. Because after you buy the property, the taxes are going to be reassessed. The property value is going to be reassessed. And if the seller purchased the property at a much cheaper price than what you're buying, well, then chances are their taxes are going to go up, because now the city can say, all right, this property is now 2x more than what the seller paid for it, so now we're going to increase your taxes. This doesn't necessarily mean that your taxes are going to double, because the chances are that the city was increasing the taxes for the seller every year, but there's a limit to how much a city can increase taxes every year. However, once the property gets sold, there's no limit to how high property taxes can go. So before you buy a property, just talk to the city. Ask the assessor how much the property taxes are probably going to be, and they can give you a good rough estimate of what your property taxes will look like. Second, when it comes to insurance, this is something that you do not want to miss out on. You have to have insurance, and the insurance here is going to do 2 things. One is going to insure the property, and second, it's going to insure you. So you want to insure the property because in case something happens to the property, it gets burned down or something really bad happens to the property, that you have insurance to cover the cost of the building. The second side is your liability, because if your tenant slips and falls on the property and they decide to sue you, you want to make sure that you have insurance to protect you from this lawsuit. And the reality, especially if you're in America, is that anybody can sue anyone for anything. I can tell you this from personal experience because my real estate company was sued because one of my tenants sued my real estate company because they claimed that the bathtub was too slippery when the water was on, and this caused the tenant to slip in the bathtub. It was completely a frivolous lawsuit. The tenant worked with one of those free attorneys who was just trying to get a settlement from my insurance because they know that we have insurance. But the reality is, if I did not have insurance, well, then I would have to go out and hire an attorney and pay somebody out of my pocket to try to dispute this, and it would have been so much more expensive out of my pocket. But because I had insurance, it didn't really come out of my pocket. It came out of my insurance's money because I pay money into my insurance every single month. And so while my insurance company had to settle to make them go away, which is pretty crazy, it didn't come out of my pocket. So you want to make sure you have insurance because you never know who's going to sue you for what. That's just the reality of this country. Third, you have to factor in maintenance. Even if you think this property is up and running, is perfect, is brand new, always factor in some sort of maintenance fee every single month per unit. And even if you don't use this money, well, now your real profits are just going to be higher than your projected profits, which I'm okay with. So always factor in some sort of maintenance when you're running the numbers. So you might see, okay, this unit, this house is making $1,500 a month. And you might factor in $100 a month or $150 a month for maintenance. But if you don't use that, well, that's an extra $150 in your pocket. But if you don't factor in the maintenance when you're looking at the revenue minus your expenses, and you're already running this deal super tight, and then you find out that you have maintenance expenses, well, now you're in the red, you're running a negative, you're running a loss because you didn't factor in the maintenance to begin with. So always factor in some sort of maintenance cost. Fourth, factor in a management fee. I don't recommend that you manage a property yourself. I always recommend that you hire a professional property manager whose sole job is to manage the property. Make sure that property is leased out. Make sure the tenant pays to document everything that's going on with the tenant, to fix the repairs, to get everything done with the property. But if you really insist on managing the property yourself, I would still recommend factoring in this management fee. That way you know what the cost is for the management. You're just paying this to yourself. But now, at least when you're factoring together the deal, you understand how much this would be, because now if you try to sell this as an investment, unit. If you try to sell your property as an investment deal, the new investor is going to factor in a management fee, even if they don't want to manage it themselves. They're going to factor that into their pro forma, meaning their spreadsheet. And so if there's no management fee for when you buy it, you might be overpaying for something that you can't sell for the same price. So make sure you factor in a management fee when you're looking to buy a property. That way you know that it's going to be profitable for you. And the last one here is a vacancy cost, because the reality is sometimes tenants are going to leave. And when a tenant leaves, there's going to be time before the new tenant moves in. So you want to factor in a vacancy cost. And you can even apply a very simple 1 month a year vacancy cost. That way now, once you factor in all these expenses, you can see what the property would look like. Now, if nobody leaves, if you have very little maintenance, if your property taxes aren't as high, no big deal. You just have more money in your pocket. But at least you took that conservative financial statement and you knew what the expenses would be, and you factored in the other potential costs, because the last thing that you want is for you to anticipate making a profit, but then you're losing money every single year. And then you also want to factor in your mortgage. If you're going to not purchase a property cash, if you're going to have debt on the property, you want to also make sure you factor in the mortgage. And then you want to make sure that now, after you factor in all these costs, that it's still profitable for you. My goal when I invest in real estate is to make a minimum 7% cash on cash return on my money. Meaning, if I go out and I invest, say, $100,000 of my own cash, I want to make sure that after paying all of these expenses, this property is putting $7,000 of profit into my pocket every single month from cash flow. Not from invisible appreciation of the property value, but from actual cash flow from the property. That's the type of return that I'm looking for. Yes, these types of returns are possible here in the Midwest, which is where I'm located, but it's going to vary area to area. But these are the types of returns that I'm looking for. So what you want to do is you need to know what type of return is good for you, and then make sure now that you factor in all of your expenses, and then see if the deal works for the numbers. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.